Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. In heroic fashion, apparently, so I'm sorry. This is market call. 1 o'clock on the East Coast. Guy Adami, Dan Nathan, soon to be joined by Carter Worth.
Carter Braxton Worth.
Because we're learning is you need to sort of set these things up.
Yeah, so we have a great show.
Every day is a great show.
Guy and Dan.
Hold on a second. I don't know if you can. I guess people can see what you're wearing. What exactly is that?
It's a heart. So listen, people don't get it. Okay, so Guy and I, we're business partners. We are co-panelists on CNBC.
But we don't wear the same clothes.
No, we are obviously co-hosts of podcasts here. We couldn't be more different. Is that
well?
Fair
I mean,
to say?
That's probably true.
That is true.
That's probably
you're
true.
all knotted up, and this is how I want to dress. All right.
But what is that?
It's a heart. Look, you see that?
Amanda's about to get in my ear. Okay. Carter's going to join us. Big day. Walmart. We're going to talk about a lot of things. Throw that rundown up because why not? Chart check on stocks. Consumer spending spikes. That's not easy to say, by the way. Party like it's 1999. That's an Amanda Diaz
2 in a row
special. I mean, she probably, when she came up with that, she was
giggled.
Yeah. And she had a big smile on her face because that allows her to do all that wonky TV stuff that she does and a little audience Q&A. So let's get right into it because I think if you really want to get into it, consumer spending, that was the story. I think that was the story today. Obviously, Walmart being a part of that. But July consumer retail sales were up 1% better, 1%, which was better than expected, Dan.
Yeah, so 0.3 was the estimate. And again, what we took out of Q2 earnings and some of the caution that we heard for Q3 or the back half of the year, right? And this was all about a month ago or so. You would have left that period thinking, all right, that consumer is weakening here. And what does that mean? That's 2/3 of GDP or maybe a little bit more. And some of the data of late, like what I find interesting about this print here, Guy, this morning is like we opened up a little. Okay. So Walmart was trading in the pre-market, I think up 8% or something like that. It's moderated a little bit since then. And we open up flat-ish or up 20 basis points or something, and we just start raging. So what is it that the algos or any individual PMs saw in that data? Because it's not the sort of data would say, oh, take it to the bank. The Fed's going to be cutting interest rates, as soon as September. If you look at Fed funds, let's just throw that up there. The probability of a 50 basis point cut has been bleeding, right? For the last few days. And here we are. It's still up above, I don't know, it's a near certainty that they're going to cut 25 in September. But Guy, I am not so sure about that.
Well, it's interesting. Again, when you see numbers like this, I mean, what is the urgency to cut? I mean, why, just if they can sort of continue to sort of cruise along at 30,000 feet, and not do anything, I think that's the best case scenario. People say you're nuts. Inflation is slowing. There's some slowdown in the economy in terms of some of the ISM data, blah, 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 but then you see retail. So I guess the point is the cross currents continue to be significant. And the fact that we go from emergency 75-point rate cut last Monday to the potential for, see it in this chart, the waning need for rate cuts in September, it's just fascinating to me.
Well, listen, the other point is when we think about where Fed funds is, where we think about unemployment is, what we think about where GDP is, let's just kind of walk through that for 1 second here. Okay. So the average Fed funds rate over the last 25 years has been about like 5.25%, 5.5%. That's where we are right now. And you think about it, there were two extended periods where rates went precipitously low. We're basically at 0%. So that skews, somewhat that obviously that Fed funds rate. Let's think about where GDP was. GDP average for the 10 years prior to the pandemic, about 2.2%. We just saw 2.9% ratcheted up from, the Atlanta Fed GDP tracker, right? And then, so just put it all together. Unemployment, okay, was just at what, 3.5, 3.6%?
3.4, I think it's, but yes,
okay.
To your point.
So you know what the average unemployment has been over the last 25 years?
Hold on, don't say anything. If I had to guess, it's 4.6%.
It's a little higher. It's like about 5% or so. Yeah. Now, again, we had COVID and we had the financial crisis, and those things are kind of outliers to the upside. So again, I don't think there's any cause for alarm right now. And I think that if you're thinking about politics, the Fed is probably best off not doing a 25 basis point cut in September.
That's
Let's
what
wait
I
until
think as
November.
well. So we should bring him in.
Let's do it. Carter Worth of Worth Charting. Carter,
How are you?
how are you, man?
Lots going on as always.
I'm always just mesmerized by it. Hello, Carter.
Well, hit the ball well and have the ball hit you in the face, as they say.
Let's look at your S&P charts because we get right into it because, again, you have this gap higher, and it's going to be when you start putting the lines in, I think it's going to be very interesting as to where we were and where we are now.
Right. So before we annotate it in any way, you have obviously this, we're on the 1 month anniversary of the peak. That's July 16th. We sell off 9.71%, and now we're ricocheted back about 8%. But let's put the next iteration up. You can even flash that for fun. So what we've got, of course, is the uptrend in effect since the October low. A break in trend, and now we've thrown back to the underside of the channel. We're right there. An inherently difficult level. And why? Not just because the lines are there. After a sell-off of a certain magnitude, not 2-3%, but 9-10%, you have many people who didn't do any selling, and that when it's down there at now 9, down almost 10, they're like, oh boy, this is not nice. I've been treated well by the market. I've made quite a bit of money. I'm overweight maybe in my AI trade. It's been clever, but now I'm down 10% from the peak. And so when you bounce back a certain amount or a decent amount, you induce sellers from above who now have recouped a great bit of their losses. So there's memory above, and then there's memory below. Whoever nailed it on the dead low, the most hapless sort of individual or the most brilliant trader of all time, when you buy something, dumb luck or brilliance, and they pay you out at 8% in 5-7 sessions, that memory kicks in. Man, I should book this. That was a gamble. I made it. And so you're back to a difficult level, both in terms of the chart, but conceptually, where memory kicks in, where shares emerge onto the market from below. I bought well, let me book it. From above, I lost a lot of money on paper, but now I've recouped those losses. Let me reduce.
All right, couple things. So Lori Calvasina was on Squawk Box the other day, and she had mentioned they did some work. They looked at the week last week, and she had actually looked at it a few times. What she learned was the positioning didn't change. The market longs versus shorts did not change based on what we saw last week. And I think she was surprised by that. And it led her to believe maybe we're still in the same place we were a few weeks ago in terms of market positioning, number one. Number two, I look at this and say the best thing that could have happened, in my opinion, we breached that channel. We trade down to the April lows. We hold, we bounce, and then we're off to the races again. The fact that we didn't, and now we're sort of retesting this channel, but seemingly potentially could fail here, to me actually sets up worse. Am I looking at it correctly given those two things?
Well, right. You would postulate it going down to the April low and holding and forming a double bottom of sorts. It didn't quite get down there, of course, and now we have ricocheted substantially. One way to look at it is if you, with your eye, you take the low of 5-7 sessions ago and this entire move up, and you put it down instead. So had we done these 5-7 sessions up that we've done, from essentially 5,200 to 55 plus, if you take it 300 points off and we'd undercut the April low, we would be good and truly oversold, right? Mm-hmm. And that would be something as an opportunity, I would think, to add it more aggressively. The question is, and I think everyone is struggling with this, is it done? Right? Meaning, was a 14 session, 3 weeks, that's not nothing, 10%, 9.7, but let's call it 10% sell-off. Was that enough to reset the market after such an impressive period of strength over so many weeks and weeks and months? It seems a little too quick to me, a little too easy, a little too like, okay, that's it, off to the races, dust yourself off. But that's the way the market is interpreting it now. My hunch is to fade, or at least if one bought on the low or close to low, sell calls, reduce the position, and surely if one didn't do any selling at all and had the losses that were on paper, many of which have been recouped, to reduce into the bounce.
Yeah. So Carter, I got 2 things for you. Let's start with this one. Okay. So I saw a report this morning, it was out of Bloomberg, that Goldman Sachs, they're saying their buyback desk, this was last Monday, the day that we had that sort of crescendo, right? Saw the largest amount of buybacks, buying, I guess, 2-to-1 that they've ever seen. So it's interesting to me that the corporations that have these buybacks that were maybe a bit hesitant to do that at the highs, maybe last July, we know a couple months ago, Jamie Dimon said quite emphatically they're not buying their shares back at those sort of all-time high levels. So I want to go to your next chart, to me, which I think is really interesting. So what I see, I'm assuming that's a weekly. Is that what you have going on?
These
there?
are weekly bars, correct? So
yeah,
big week. And turns out, of course, last week wasn't that big down week. Intra week it was, but it closed the preceding week. That was the down week.
Right. And so we talked a little bit about that price action last week. So you look at that, I call that a spike bottom, right? So we had that prior week, we closed on the low, we gapped down on Monday. You see basically the low tick of the day, that's on the left side, right? We trade in this huge range, we close on the highs, and then the next week we open unchanged, but we keep going. I mean, that's one of the kind of the most bullish patterns that, at least that in my 25 years that I've seen, that sort of spike bottom. So how much of it doesn't matter. You're not going to be able to guess. How much of it was corporates kind of putting in a bottom using their buybacks, and then you have shorts chasing, and then you have folks, just kind of chasing the most high beta sort of stuff?
Sure. I mean, the history of buybacks, of course, is that typically they're done at market peaks, right? Very poor timing on that. You can look that up or Google it and get some real research. But if indeed there was buyback programs entering at or near lows, those look to be quite timely. In terms of the reversal, it's very sharp. It's the mirror image of the sell-off, right? So an aggressive sell-off, which had a concomitant spike in the VIX, not seen since the 09 low and the COVID low, and now a follow-through from last week's intra-week reversal, leaving us sort of where we were the week prior, right, to the sell-off week. And so this is the big moment, right? Is it all done? Do you shake it off and make a new high? Or is it's many ways. What's the primary data point and what's the secondary data point? Like if you look at footnotes in a research paper, there's primary source, then secondary, tertiary. Is the sell-off the primary thing in this ricochet secondary? Or is this ricochet the primary data point? My hunch is the latter, that the sell-off is the primary event of the past many weeks, and that the ricochet is secondary.
Let's look at your final S&P chart with the channel with the middle line, because this, I think, is interesting as well. So walk us through. You obviously draw these lines for a reason. Walk us through.
Yeah, I mean, here, which is remarkable, we've gapped up, and now we're back to and slightly above the upper band of this mathematically very simple. These are parallel lines, mathematically parallel, not fitted or adjusted by me. And so we have an overshoot of the channel, and then we have this major, dip into the channel, the 10% sell-off, and now we're back to and slightly above the upper band. The gap's a bit of a problem. That speaks to a bit impetuousness and knee-jerk. So we'll see. It's whether you back and fill, catch the gap, fill it, and then can stabilize. Or look, there are many people thinking it all just is a classic ricochet in the context of more downside. Seasonally, we know it's not a great period, the next 6 to 7 weeks. And we also know there are unusual events coming up, most specifically the presidential election in the United States.
Well, let's talk, I think, the first unusual event, and that's next week, right? So it's this Fed confab, Jackson Hole. Fed Chair Powell is going to speak, and let's just say you heard us talking at the top of this program. Given some of the data here, it's really changed a lot. You know what I mean, in the last 2 weeks or week over week, and I think your charts kind of demonstrate what's going on. The bearishness around maybe the jobs market and the bullishness now around the consumer. If the Fed Chair Powell, signals, let's say he's a bit hawkish next week, like meaning, just if he's not nearly as dovish as, let's say, the Fed Fund futures kind of are expecting for the September meeting, this would be the level, right, in which to fail here. I just want to go to the chart prior here to your monthly. I think this is a monthly, right? And this tells...
Yeah, this one, right.
Mm-hmm. Yes, this tells a little...
Yeah, go ahead.
No, it just tells a little bit of a different story than the weekly. So
that's right.
Yeah.
Yeah, I mean, I included that as opposed to the weekly. Let's go to the weekly and then that's the segue to. So the weekly, we have a 4-week sell-off that hasn't happened since the bear market of 2022 when the S&P dropped 27%, Nasdaq dropped 37, 4 weeks in a row down. And then this week, a big ricochet, but put it in the context of the monthly. And with today's strength, that bar there, and if you do candlesticks, they call that a hangman. There's all sorts of nomenclature, but it's what a reversal is. And with today's strength, that bar turned green, right? That bar was red. And so for the month, and obviously the month has plenty to go, we are now, it's all gone. If one were looking at from 30,000 feet, you're like, where's the sell-off? I don't see any red.
Yep. I got you. Really quickly, Guy, we got a VIX below 16.
I mean, think about it. It was a 60 VIX last Monday.
Yeah, and listen, we talked about it at the time. That felt a little fugazi.
Yeah.
There was
we didn't say it was staying there, but yeah,
but even that calculation of what happened on that day, it seemed like there was kind of some funky stuff going on. But I want to talk about this. Okay, so if next week is the 22nd, where Jay Powell's going to speak, right, and some of the data has clearly changed, at least market participants' mindset. The stock market's rallying here, and you would think the data was bad, right? Like it was worse than expected, which would give greater confidence that the Fed was going to lower interest rates, and people have been buying stocks off of that, or at least the algos have been. So when you think about the at the money straddle, okay, in the SPY, that's the ETF that tracks the SPX, it's about $9. That's how much the SPY is up today, right? And so think about this. That's 1.6% of the SPY here. On the flip side of that, if you look at the 552 put for next week on the 23rd, that would cost you $3.75 or so. Okay, so just think about that. That is what, if you were bearish, if you looked at everything that Carter just showed you and walked you through, and you thought there was a chance that, I don't know if there's any data before he speaks, though, you know what I mean? That they basically hint that maybe they're not going to raise in September. Doesn't the stock market get, doesn't the stock market get flushed here?
Yeah, and it seems like you're getting a shot. I mean, vol has come all the way back for you, and it seems cheap enough where it's a very reasonable bet to make, given where we were just, again, 8 or 9 trading days or so ago.
Yeah. All right, let's talk about the other thing that's kind of contributing to this excitement here in the stock market.
Walmart.
That'd be Walmart. Guy, walk us through what you heard based on that report, that guidance. Look at the stock gapping to a new all-time high. It's 2 gaps in a row. Carter, I think that's usually your number. When you see one, you see another. So what did you see?
All right, so there are a couple things. I mean, that's one thing we have gotten right, has been Walmart, number one. I mean, when you see comps up 4.3% with Walmart and the street was expecting 3.7, that's a pretty significant number. Revenue definitely beat, but then you sort of go down the lines and you look, operating margins, 4.7%, beat by 1/10 of one. It was 4.6% were expectations. Like, that's not a big beat. For a name like Walmart, that's a big beat. And then you look at this, and this is what sort of stuck with me. Inventories are still, they're really managing well, down 2% year over year against 4.7% sales growth year over year, which suggests that margins are going to hold in there, which suggests that everything we've talked about is still happening. People are going to Walmart in droves, and it's Walmart's world that everybody else is living in right now. So this move seems a bit excessive to me. You're going to have a big volume day, but with that said, I think it just, again, speaks to what's going on in terms of the consumer. They're all in droves are going to Walmart.
And the trade down, which you've been talking about. Maybe they can pull up a 2-day chart of the Walmart. And then, Carter, I'd love to get your take. So you often say that the gaps come in twos, right? So we had that gap. Just opine on this 2-day chart for a second here. So we have this huge gap, and then it just flatlines like this. You know what I mean? So it'll be really interesting to me whether it stays here, whether it makes a move back towards the morning's opening highs, or whether it starts to fill in a little gap, because the fundamental story sounds great. You couple that with some of the retail data that we had this morning, I guess there's no reason that it should give anything up here. So thoughts on the 2-day and then obviously the 1 year.
Yeah, I mean, markets are inefficient, but they're very efficient, and efficient market theory is insane and it's been completely debunked. But markets are very efficient on the day of an event to re-rate a security to where it belongs, right? And so this gaps up typically, or gaps down on the open, and it's sticks its landing. It just stays there. And that's exactly what's happened today. But if we go back to the 1-year chart, just to put this gap in context, this is the third, right? And so you have the gap in February, you have the gap in May, and then you have the gap in August. Those are all 13 weeks apart: February, March, April, May, June, July, August. Quarterly gap. Gaps come in 2s or 3s. You almost never get 4. Why is that? So when you get a gap, how can a security on the open gap up? It's news. But why would it gap up if analysts were accurate? And it's because the news is so much better than the analyst community on Wall Street, sell-siders, have predicted, that the security lurches higher to be re-rated by the buy side, by the owners of capital, to where it belongs with the new information. And then analysts change their price targets, like, oh boy, I guess I'm a little light. And then it gaps another quarter. And then analysts do it again. Analysts don't predict, they trail behind. There's a lot of data on this. So now what happens is the price targets get moved yet again. But at some point, they've now moved them up to the point where they're discounting. You very rarely get a fourth gap because now price targets are moved up.
Well, Carter, I was going to answer your question.
I would sell calls. Sell calls or sell the whole thing.
Sell
32
calls.
times earnings.
Well, it always trades at a multiple that is far greater than many.
But now even more so now. Yes.
Well, Guy, I was going to answer his question about why it gapped up more buyers and sellers, but
that's a good answer. That's always the right answer.
And just to talk to the analyst stuff. So 40 buys, 3 holds, and 1 sell. All right, Guy, this is, I think, probably the most exciting portion of the show for you here.
This is Amanda's
parting
portion.
like it's 1999. So we threw these up because it's so interesting. DELL, Cisco, Amazon, Intel. I mean, these were 4 of the darlings, and there was a handful more. It was Qualcomm, it was Nortel and Lucent, and a few of those other internet stocks that were also very exciting. But you look at this move by DELL. You said it the other night on Fast Money, Guy, that 40% drawdown that we saw over the last few months since its earnings. You said, I think you used the term de-risked. You know what I mean? So JP Morgan makes it a top pick. Cisco last night said something, and we talked about this a little yesterday. We thought it was washed out, but if they were to guide lower, maybe you get this flush like Intel had, but it was better than expected. They crossed $1 billion in AI-related sales. Okay, so people like that. Inventories are being drawn down. Amazon, one of the hardest hit names from the Q2 earnings period, the Mag 7, is having a good day. It's outperforming a NASDAQ that's up, 2%, almost by double. And then Intel, I mean, this one, maybe they can pull up Intel for a second here. You've kind of mentioned this on a few occasions while after the gap here. It's like, listen, all these gaps get filled sooner or later. Carter will talk to you about that. And SoftBank's talking about, you see that, discussed AI chips. So you've been saying this, that they're got a huge beneficiary of this CHIPS Act. So talk to us about this little pastiche.
Yeah. If you look at, you mentioned all the names. DELL, this is the one that I looked at first. Think about, what we did here in DELL, and we actually talked about it on Fast Money, is we round tripped the move from basically earlier this year that we saw that huge spike higher. And this sort of the level we got down to, and I think, Dan, we got down to almost $85 or so last Monday. That was basically the breakout point from February. So it all sort of made sense. That you talk about this a lot. You're not pressing things on the short side. That's where if you've been short, you're looking to cover, or if you're looking for an entry point, you got it. And we had a big volume day. So all these moves make sense. The question is it the beginning of the next leg higher, or is it just sort of a bit of a relief rally? I think we're going to know a lot more when NVIDIA reports, but before then, we're going to have to make some decisions as well.
Well, the good news is we have someone who can help us figure that out on the technicals. I just say one thing about valuation: trading 14 times this year, 12 times next, and expected to have double-digit earnings and sales growth. So to me, relative to a super micro, which Intel or DELL has double the margin, nearly 23%, versus a super micro that just reported 11.5% margin. Those margins are supposed to be, up a little bit year over year. Carter, what are you seeing in the chart of DELL?
Yeah, what's so incredible is the way you decided the B. So on the peak, the stock drops 52%, right? That incredible surge and then collapse. Think about that. At that high, just 10 weeks ago, it was a 31 PE. It drops to a 15 PE, and this is the vagaries of valuation. How could the investment community, the world, global investors value Dell 1 day, 1 hour, 31 times, and then decide it's only 15. One could say, well, how in the hell can the chart be so good and then so bad? This is the nature of what is risk assets. But what to do now? I would sell calls against the ricochet at the 150 day. That's what comes to my mind, independent of whether 31 times was expensive or 15 times just days ago was cheap. It's a big ricochet, as is the case with almost all stocks that crashed. And that is a crash, 52% down from the June high. There's no way around it. And my hunch is to reduce into the bounce.
Guy, last night you were on this set of Fast Money. The Cisco results are coming out. What was your initial take here? Because just from a purely technical standpoint, if you want to pull that chart up, you see that downtrend, you see that 200-day moving average. It's probably not too far from Carter's 50-day. It, sold off throughout the day, bounced off of that 200-day. So give us a take on the fundamentals, and I'd love to hear what.
Well,
Carter
I mean, I
thinks
thought the quarter was fine. I don't think the quarter was great. I said last night, and I think it's in large part true. I think the market rallied, the stock rallied on the back of job cuts. I mean, this whole companies are using these. We're exploring efficiencies, which is code word for we're laying people off.
Yeah.
And you're seeing it. We've talked about it for a while now. You're seeing a lot of technology companies, but across a swath of industries. And at some point, that's going to it's manifesting itself in the unemployment rate without question. So this, to me, bit of a relief rally. Clearly, we'll see how long it lasts. I mean, maybe we get back to the sort of the highs that we saw earlier this year in Cisco, which what is that, about 52 or so. But I think it probably stalls there, Dan.
So Carter, is this breakout above that downtrend? Is it a meaningful downtrend? Would you have drawn that line? And is this something that you think has some legs?
Well, a couple of things. For starters, we published on this as likely to be a bad result, not the fundamentals, but a bad price action post result. Is the exact opposite. Is gapped up. The one thing that stands out to my eye is that intraday we're on the low of the day. Market's on the high of the day, and that's the case with Walmart as well. Meaning the follow through is not there. The gap is in play, but we're trading at the low of the session or quite close to it, and it feels more impetuous, more relief rally than the beginning of something that's enduring. This is perennially a cheap stock, PE wise, if one wants to take that basic metrics, and it remains cheap. But I mean, here's something that is such an underperformer. And such a problem stock. We know, of course, it's still below its 2000 peak, right? It's trading half its value of $82 a share in the .com high. Adjusted for inflation, it's lost 70% of its value. It feels like just too little, too late. My hunch is to fade it if you got gains here.
Yeah, the only thing I'd say here is that, the S&P now is just a couple percent from its all-time highs. Let's just say we break out, we keep going. They're going to come for everything, right? I'm just telling you, like, you're going to see the crap, you know what I mean, getting bought here. And again, I have no idea if that's going to be the case. I want to look at Intel really quickly. We played a little game, Guy, on Fast Money. I think it was Tuesday night. We're talking about if activists are coming for some stuff. Your pick was Intel, and we'll get to that in a second here. I just think this one's kind of interesting here. It is so washed out. We just talked about, the sentiment on the sell side as it relates to a Walmart. But look at this, the Intel right here. I mean, it's 6 buys, 37 holds, and 6 sells. Okay, so the analysts have just been puking it out as they've been wrong for a long time defending this sort of thing. And so my point here is, like, if you want to define your risk in Intel, this could set up kind of interesting, maybe at this level here. Maybe that's not much of a level. I just wanted to kind of highlight the fact that if you even go back below, where that kind of level is, below 20, that seemed like not down there for too long. Maybe this is support, maybe not. We'll give Carter a second to opine on that in a minute or so. So if you're looking to define your risk to basically that line that I drew, you might look to October expiration with a stock around 2065. The OC21 calls will cost you $1.28. When you think about that from a premium standpoint, it's almost 6%. Okay, and that's what you're stopped out right there. But above that, you know what I mean? You have obviously unlimited gains. So Guy, walk us through a little bit what your thinking was when you highlighted Intel as a potential activist bait.
Well, if you think, I mean, look, I mean, we are in the golden era of semiconductor stocks, right? I mean, and the market's effectively at an all-time high. Yet you look at a name like Intel, and that last quarter was an abject disaster. By the way, that's coming off of a series of disasters. I mean, just go back again, not that it matters, but in the spring of 2021, this was a $70 stock. Now it's trading $20. So think about the juxtaposition between an Intel as opposed to an AMD, as opposed to obviously an NVIDIA, number one. Number two, maybe they just need a management. I mean, at a certain point, it does fall on management. And it's one of those things where, like in Starbucks, you see a management change of that magnitude, you see what it can do to a stock. I think you could see the same type of thing in Intel. And what I said about Starbucks problems are not fixed, but you can get those types of knee-jerk reaction. And I think the same thing can happen here. A $20 stock, is it preposterous to think on the back of an announcement like that it's 25? Absolutely not. Again, it doesn't mean the company is fixed, but you're playing for the stock right now, not the company. Dan.
Well, yeah, and it's interesting when the CEO Pat Gelsinger came in a few years ago, it was supposed to be a big turnaround, right? And so
it turned around.
It's a turnaround. So to your point, I see what you see from a fundamental standpoint. It's bad. It's not getting any better anytime soon. I think it's interesting that SoftBank's talking to them. Carter, if we go to that 1-year chart for a second here, what do you think? Define your risk to 5-6%. You play for maybe the potential for a gap fill here if there's any news whatsoever. And that's one of the reasons why I didn't turn this into a call spread. I didn't want to kind of limit the upside here.
Yeah, I mean, it's a heavy lift to fill that gap. I wouldn't think that happens. It's tough that's not likely on a short-term basis, right? Obviously, it's out there as a potential trade. My own hunch is here again, it is this nonsense of efficient market theory has been put to bed, but markets are very efficient on the day of news to take a security. Why is that? Let's spend 1 second on it. Okay, well, let's take biggest firms in the world, from Fidelity or Wellington with their trillions of dollars. How many analysts and portfolio managers did an hour of work on Intel the day of that news? Several did 2 hours. Some whole teams did 8. But how about people not only in Boston, but New York, Dubai, Chicago? Thousands and thousands of women hours go into studying the new facts, updating the model. And then when the market opens, boom, it goes right there because it's a lot of inputs and it sticks its landing. This is elemental. You should know it. Everyone knows it. Okay, so the question is, do you sell puts when there's someone thinks it's going to gap down again? It's not going to gap down again. That's not how it works. Gaps don't come this quickly. So I would sell premium to be the insurance company. The person who's lost their mind, who's afraid, sell them puts. Be willing to. It's like it's just a good till cancel order out there. Collect the premium, wait, and if you're willing to buy Intel lower, okay, it gets put to you.
Wait, before we get to questions, because I know you're dying to do some questions. You love the questions.
Love the questions.
Let's do AMAT really quickly. So this is Applied Material. It's an equipment maker. They sell to Intel. They sell to Samsung. They sell to Taiwan Semiconductor. They sell to Micron. Okay, so they make the machines that make the chips here. Guy, implied move, 5% in either direction. Tonight after close, this looks a lot like DELL, right? I mean, it didn't have the magnitude of the sell-off, but when you think about, you highlighted this, I think the other day, what Taiwan Semi had to say, you know what I mean? So talk to us a little bit about this one. Again, this is a hard one.
It is a hard one. Well, the setup is better. I mean, it went from 255. I think that was an all-time high in AMAT, and that was just a couple of weeks ago, down to about 170. I think we got down to 180, maybe even a little bit lower than that. Now we've bounced. So the question you have to ask yourself is, what's the setup? I think Carter will look at this and say it's probably a pair of twos here. I would look at it and say, you know what? I think we're going to try to fill that gap that we see on the upside, and it probably comes in somewhere around 235 to 240 is my sense.
Carter, thoughts?
Yeah, sell off, obviously. Well, just talk about the entire thing. Great advance, an equally great, impressive sell-off, and then a pretty great ricochet, leaving us all sort of a little bit in the no man's land and highly speculative going into earnings. Obviously, a big result would get you close to the 225 to 230 level. I would say more of a pair of twos, just as you intimated. It's too binary.
All right, here we go. First questions for you from Adam B. Carter, how reliable are channels in predicting future moves? Does backtesting support channel accuracy? And we actually talked about that before.
Oh, so yeah, it's just a question. It's not so much whether it's in a channel or because sometimes it doesn't fit as nicely as the optics, which is do things trend? Do sports teams trend? Political campaigns, people's careers, your personal life, your health. Yes, they're trends. This is elemental. And so good moments in the political campaign or the sports season or your life or your health, you're trending up, and then you have downtrend periods. And so the answer is whether it fits into a channel or not, most certainly it is right to study and follow the trend, the primary trend of the subject at hand.
One of the names that we've been constructive on, and it's playing out, is Palantir. And we have a question for you, Carter. Would love Carter to look at the breakout today in Palantir. And I guess the implied question is there anything left in the upside? I think the answer is yes, by the way, but Carter, PLTR, let's take a look at this.
Yeah, just pulling it up. Well, this is talk about a trend, right? I mean, this is up and to the right, but never gets too steep, sort of north by northeast, higher, ever higher, and yet it's punctuated by nice counter trends, sell-offs, dips, corrections, declines that then set up the next advance. And I would say this is orderly, likely headed higher, and I would put it as a stay long, be long circumstance.
Yeah, so it's interesting to me, and again, I'm going to just kind of look at the funny mentals, as Carter likes to call them. I feel like this stock has gotten a little bit of this excitement that is around generative AI. They've announced some contracts, that sort of thing. But 42% expected EPS growth is expected to kind of get cut in half next year. Sales growth also about 20%. Here's the thing: big step up in margins. From 2023, this year supposed to be 83% from 80.5%, and then they're supposed to kind of go flat. You know what I mean? Like, listen, any margin that you see above 80% for a company like this, that's great, but it trades at about 87 times this year, 72 times next. At some point, I would suspect that valuation is going to become a thing. But to Carter's point, just purely technical, look where that stock gapped down to on the 5th, right to that 200-day moving average, and found, it's opened on the lows, closed on the highs, not too different what we saw on the SPX on a weekly basis. So, I'm a bit more skeptical, guy.
Fair enough. Scott's asking, Carter, certain time frames. Is there a certain time frame you switch from log charts, or you always look at log charts?
All charts are fair game. So just speaking directly to the arithmetic versus log, if you have a great rate of change over a long period of time, so for instance, if you did a long-term chart of the S&P arithmetic going back to 1980, you cannot see the 1987 crash. It doesn't even appear on the chart because the current levels on the y-axis are so high that it mutes the rate of change. So nonlinear chart, a log chart, tries to depict that. And so it is important when you're looking at long-term charts to try to pick up the perspective of the past and the context of the current chart by using log if there is a great rate of change. If you have a stock that's sideways, like Ford Motor, same price it was 30 years ago, it really doesn't much matter whether you use arithmetic or log. But all time frames are valid and important, and both arithmetic and log.
Ramesh is asking, Dan, this is you, but we can all probably, can the team opine on SMH? It now sits above the 10, 20, 100, and 200-day moving average, but it's yet to cross the 50-day. I think that's what he's saying. I think I read that correctly. I'll say real quick, I thought the sell-off obviously was going to continue. I still think sort of 165, there's sort of a magnet to me in terms of where it's headed, but I mean, think about what we just did. We just bounced from, I think, 210 or so, that low, all the way to 245, pretty much in 5 trading days, Dan.
Yeah, and this kind of goes back to the makeup, right, of this ETF. We know that NVIDIA still is a disproportionate weight. I think that Taiwan Semi and NVIDIA are
probably close to 40%.
Yeah,
that's a guess.
I'm going to pull it up right here. So NVIDIA is about 21%. Yeah, and then Taiwan Semi is about 14%. Look at you. Listen, NVIDIA, we're going to get it. It's going to be August 28th. And, my view is very clearly, we've seen let's pull up NVIDIA for 1 second here. We've seen, multiple gaps on earnings. Carter just said it before. I think we've had 3 consecutive ones. You don't usually get a fourth. Who knows? As far as I'm concerned, that's still in a downtrend. I'll let Carter speak to that. But any decel that is evident in their guidance, and I think this stock, is back testing the lower bounds of that downtrend. And you know what? That puts that 200-day moving average in play. That also puts, that level where the April lows were. So that's just my 2 cents. Carter, I'd love to hear what you have to say.
Well, on SMH, I think we can do NVIDIA, but if you to the question about, the nasty nature of the math, right? When you drop 29%, which is the peak to trough sell-off, and now we're back up 23. So we've almost undone on a percentage base the entire sell-off, but we're still 12% below the high. As to NVIDIA, look, there will be such a knock-on effect either way, right? If NVIDIA were to gap up and put on 10, 12, sometimes it does even more. That stock is such a phenom right now. The market and all the follow-on, you will likely push very close to the all-time high of July 16th. And in turn, one could say, wait, you're going to tell us if it goes up, it's good. And if it goes, I'm not saying that. I'm just saying that NVIDIA, people, all eyes are on that. Just as at certain moments, it was Apple. That's not really the case now, or Tesla. This is the one. And here and now, it's too binary. I mean, I wouldn't commit capital either way in front of the trade.
Last question is from XLiquid99X. I love this. When you assess NVIDIA, to take into account the private money that's going into data centers and AI build out. I mean, the short answer is that whether it's coming, where the money is coming from makes its way into the earnings report for NVIDIA. So if you see revenue, whatever the revenue is, that takes into consideration all sources of revenue, be it public or private markets. So the short answer is yes.
Yeah. And one thing that we've kind of mentioned on many occasions is, what's going on in the private markets right now, valuations are skipping higher. They're probably much higher than many of them in the public markets. And a lot of these companies don't obviously have any earnings, and they actually don't have a lot of revenue. If you look at OpenAI, which is obviously one of the biggest buyers of NVIDIA's, GPUs, I think they're going to do $2 or $3 billion in revenue. And that may sound like a lot, but it was last valued at $85 billion. So you do the math there. The other thing I'll just say is that all these companies that are getting these investments, from an NVIDIA, for instance, they're very active in the private markets. Well, what's going on? They're funding these private startups, and then those startups are turning around and using that money to buy their chips. And we've seen this before. We saw it 25 years ago. Well, all the vendor financing, it was Cisco, it was Sun Micro, it was Oracle. And that didn't end up too well when the music stopped here. So I'm not saying the music's going to stop, but we had this conversation on Fast Money Guy, I think on Tuesday. And I just said this, it's not so simple where it goes from A to B. Like, NVIDIA got to $3.3 trillion in market cap. It overtook Microsoft and Apple for like a day or two or so. And then it dropped, $600 billion or something like that. At some point, it might be down 50%. And you know what? In 3 years, it might be a $5 trillion market cap company. But again, Carter, you use this term all the time. A sort of unabated sort of move is not the sort of thing that you want to bet on long term, right?
You want, not to say you want setbacks, but when something is, everyone's on the same side. What's that joke? It's like the law of summer camp. You kind of want to know where the fat kid is in the canoe, right? I mean, and that's a little kind of, but I mean, the whole boat flips over. The point is that when everyone's in agreement, that's when things do go wrong. Everyone was in agreement on AI until this sell-off, which took Micron down 45% and took Dell down 52%. And so setbacks or re-ratings are important because it shakes some people out. It resets valuation or resets the tone and tenor of, and we've had a major reset in NVIDIA. And so to some extent, it's a lot healthier here and now than it was as it was just pressing higher and higher and ever higher, and they exceeded the value of Apple. But to be clear on the fundamentals, I mean, we have a company that is producing quarterly revenue growth or that are exceeding the annual growth in total just 2 years ago. So obviously a remarkable moment in time. Nothing is forever.
Let's talk about the market matrix, Dan.
Oh yeah, that's a podcast that you and we started with our team probably about 3 months ago or so, Guy. Would you say so? And it's MRKT Matrix. What we do is we pick 10 of the most impactful stories for the markets and in business. We use Perplexity to summarize it. We take the text, we bang it into an 11 Labs voice bot. That's Brunson, who reads it under 10 minutes. And listen, if you do it at 1.5, it probably comes in at, I don't know, 7 minutes or so, Guy. And you are up to speed on what went on in the market that day. It drops shortly after the close. Go to your favorite podcast store, follow it, rate it, review it, and share it with some friends.
Market's screaming higher here as we get to the final 2 hours and 15 minutes of the day. Let's see how it shakes out. I want to thank the great Carter Worth. And the whole team, Bill, Timmy, Amanda, Jacob, all getting it done.
Let's thank our viewers for being here with us.
Always thank our viewers.
We really appreciate you guys being here. We hopefully you guys enjoy it. We have fun doing it. We appreciate Carter being here. We'll see you all next week, I think on Tuesday, but the On the Tape podcast drops tomorrow morning in your favorite podcast store. That's going to be a great macro conversation. Danny Moses is going to be with us. Stuart Sopp, CEO of Current. We're going to break down all of this data. And then on Monday morning, Guy, we have an On the Tape podcast with Liz Young-Thomas. She is the head market strategist at SoFi.
EYT.
Yeah, so check us out.
Later, folks.